All right, welcome to this explainer where we're going to do something really exciting. We are going to systematically value Encore Capital Group, or ECPG, using the legendary investing frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham. And then we'll back that up with some rigorous quantitative modeling. Think of this as putting the company through the ultimate guru gauntlet to figure out if the underlying math is screaming buy, hold, or sell. Let's dive in.
Here is our roadmap for the gauntlet. We'll grab a quick snapshot of the company, apply our 3 guru lenses, run the math on some quantitative models, and then bring it all together for our final verdict. So, let's kick things off with that first step and look right past the hype at the raw financial data. To ground us, ECPG is currently trading at $82.57 a share. That gives the company a market capitalization of right around $1.77 billion. Now, from a valuation standpoint, we're looking at a trailing PE ratio of just 6.41 and a price-to-book ratio of 1.89. For context, a P of 6.41 is astonishingly low. It's the kind of number that immediately tells you the broader market is pricing in some serious pessimism. And when you look at their business model, you might see why. They're an international specialty finance company that basically buys up defaulted debt for pennies on the dollar and then recovers it. They operate heavily in the US, the UK, and Europe, and they are very good at what they do, pulling in a record $718 million in global collections in just the first quarter of 2026. But here's the catch. Buying massive portfolios of debt requires a ton of upfront capital. Because of that, they carry over $4 billion in borrowings. Honestly, that's enough debt to give any conservative accountant major heartburn.
Let's move on to our first legend. How does this look through the Warren Buffett lens? We all know Buffett loves an economic moat, and you can absolutely argue ECPG has one. Their sheer scale, operational efficiency, and those deep forward flow agreements, which basically guarantee they get to buy future defaulted debt from major banks, create massive barriers to entry. But, and this is a big but, that $4 billion in debt gives them a debt-to-equity ratio of 3.90. Even if that's somewhat standard for the specialty finance sector, it absolutely tests Buffett's preference for low leverage. However, check out this return on equity, 30.70%. That easily clears Buffett's high ROE threshold. It proves that the management team is generating phenomenal returns on the capital they actually retain. And when we look at owner earnings, which is a classic Buffett metric, we take their Q1 net income, add back depreciation and amortization, adjust for capital expenditures, and we land at roughly $88.2 million for the quarter. Not bad at all. But because they've had some real earnings volatility, including net losses in 2023 and 2024, a Buffett-style investor would likely demand a steep 50% margin of safety before even thinking about buying in.
Okay, next up, the Peter Lynch lens. We're talking categories, PEG ratios, and flying under the institutional radar. Lynch always started by asking, what kind of story is this? Are we looking at a stalwart, a fast grower, or maybe a turnaround? Well, ECPG fits perfectly into the turnaround and cyclical buckets. They took some big hits in 2023 and 2024 writing down past acquisitions, but their Q1 2026 earnings per share absolutely exploded, up 100% year over year to $3.86. They are bouncing back, and they are bouncing back hard. For cyclical stock in recovery mode, this right here is where the magic happens for a Lynch investor. We have that tiny trailing PE of 6.41 paired with a massive projected EPS growth of 17.35% for the coming year. Lynch lived for situations exactly like this, where growth totally outpaces the valuation. You do the math, divide that 6.41 PE by the 17.35% growth rate, and boom, you get a PEG ratio of 0.37. In Lynch's world, anything under 1.0 is undervalued. 0.37 is just remarkably cheap. Toss in the fact that institutional ownership is minimal, meaning Wall Street hasn't crowded into this trade yet, and this becomes a screaming Peter Lynch buy. Now for the ultimate stress test. Let's look at this through the Benjamin Graham lens. If you're following Graham's strict checklist for a defensive investor, you might want to look away. ECPG fails almost everywhere. The market cap is a bit under the $2 billion target. The current ratio is 0.90, failing the liquidity test. It lacks 10 years of stable earnings, it doesn't pay a dividend, and the price to book of 1.89 is too high. The only thing it passes is a low PE ratio. So for a strictly conservative, defensive investor, this is a hard pass. But wait, Graham also had strategies for the active, enterprising investor. And for that, we have to run his famous intrinsic value formula.
We take his constant of 22.5, multiply it by ECPG's trailing 12-month earnings per share of $12.89, multiply that by the book value per share of $43.79, and take the square root.
Punch in the numbers, and we get a Graham intrinsic value of $112.69. That means at the current price of $82.57, this stock is trading at a massive 26.7% discount. Sure, a defensive investor would run from the debt, but an enterprising Graham investor, they might just jump at a margin of safety that huge. All right, let's step away from the legends for a second and just run the pure quantitative models. Building a discounted cash flow model for a debt buyer is a little tricky. On paper, their free cash flow is technically negative because they are constantly deploying cash to buy new debt portfolios. So we have to use their trailing EPS as a cash-generating proxy. We're going to project a very conservative 5% growth rate for the next 5 years, and we'll discount that back to present value using a 10% weighted average cost of capital, which feels right given the higher risk of the industry. Now, we love a good sensitivity table because it shows the art behind the math. Depending on how you tweak the WACC or the terminal growth rate, you get different outcomes. But look at our base case. Assuming a 10% WACC and a 2% perpetual growth rate, our fair value lands right at $114 per share.
And let's zoom out and look at the neighborhood. When we run a comparable company analysis against the broader finance sector, the undervaluation is glaring. ECPG is sitting at a 6.41 PE, while the sector average is way up at 20.01. Even looking ahead, the forward PE is highly depressed. The open market is pricing this incredibly cheaply relative to its peers. Okay, we have survived the gauntlet. Let's blend all these frameworks together for our final synthesis and verdict.
Look at how tightly these numbers cluster. It's actually amazing. Whether you are relying on Wall Street's analyst consensus of $111, the rigid Benjamin Graham formula at $112.69, or our mathematical DCF base case at $114, the intrinsic value is consistently pointing way above the current $82.57 stock price. We're talking about an upside ranging from 34% to nearly 38%.
So our final synthesized verdict for this explainer? It's a buy. The quantitative discount is just undeniable. The stellar ROE and Peter Lynch's crazy low PEG ratio of 0.37 effectively compensate for the heavy debt load that would normally scare off a strict Buffett or defensive Graham investor. The margin of safety here is literally too big to ignore. Ultimately, it comes down to your personal appetite for leverage. If you can stomach the debt, the math points to a very clear opportunity.
But I'm going to leave you with this final thought to ponder. When the math across multiple, totally diverse valuation frameworks so clearly screams undervaluation, is the broader market just acting irrationally? Or is it accurately pricing in the invisible underlying regulatory and economic risks of the debt collection industry? It is a fascinating standoff between true intrinsic value and market sentiment. Thanks for exploring this one with us.